7.
All right. So, welcome to the Family Office Real Estate Institute. I'm DJ Van Karen with the Heyman Family Office. Today, I'm in Dana Point, California, with a good friend of mine, Randy Norton, who's with Green Mesa Capital. Randy, thanks for being on the show.
Absolutely.
So, you guys are the cover story this year, or this upcoming issue in January. And, you know, every time we have an article, especially a feature story, we really like to focus on a couple different areas that families can really learn from. So, after talking with our managing editor, Steffi Baker, what were some of the questions that she asked you that you think can be helpful for some other families based upon maybe decisions that they may look to make, you know, whether it's going from, and I know a big one is going from a state that has a lot of tax to a state that has minimal tax, right? Because California is extremely expensive. So can you touch on that a little bit for me?
Yeah, so years ago we made a conscious decision to get our nexus out of California, and that means a lot of different
We got
things.
the shadow. Can you see the shadow?
Should we start over?
Yeah, we're going to start over. But you see you got the
Okay.
shadow on you for some reason?
Okay, I do see
What's that
that.
from?
It must be from the.
Move back a little
Let's see
bit.
if
Let's
I
see if we
can-
can move back a little bit, and I can screen coming in.
Yeah.
Is that better?
Is there still a shadow?
I think there is actually, but see, now it's on me. So that's really weird, isn't it?
Okay, it looks like if I just don't move, there's gonna be no shadow. And if you come in closer to me,
Okay.
there we go. Because the lighting actually is very good. You got
It
2
is.
sets of lights over here.
I know. That's better, right? There we go. Okay, so
I'll just try not to move.
all right. So
And the shadow's gonna be right here. So if you don't move much, you'll be
okay,
fine too.
good. Your head a little bit to the left. Can you see the shadow? Go this way a little bit.
Okay, I'll
There you
stay
go.
right here.
All right. So, welcome to the Family Office Real Estate News. My name is DJ Van Kier with the Haven Family Office. And today we're going to talk with Randy Norton from Green Mesa Capital. And him and his patriarch's actually on the cover story of the upcoming issue of Family Office Real Estate Magazine for the January 2019 edition. I can't believe it's already 2019 actually. But we always try to touch on some certain areas that families can actually learn from other families. And I know that there's some of those with you guys, especially moving assets from one state that's rather taxed, should we say, to another state that's not as nearly taxed. So in your conversation with our managing editor, Steffi Baker, what were some of the things that you talked about? And I would imagine through that conversation, it probably even made you realize some things that you hadn't realized.
If I remember all of our conversation accurately, it did deal a lot with tax planning and estate planning and why we were in Nevada today. And one of the primary reasons was both the patriarch and myself wanted a better tax strategy going forward, which required both of us to change our nexus. And we looked at several states, Washington, Wyoming, Texas, Florida, among others, and we found that Nevada by far was the best. And there's really an international trend of capital domesticating here in the United States for a few reasons. And among all of the places that it can be located, Nevada seems to be a place of choice because of the other amenities that are there, such as the entertainment, the food, the gambling, and the gaming, the entertainment. But it was really between Reno and Las Vegas. It was either going to be Incline Village or somewhere in the Henderson Green Valley area. And at the end of the day, we chose Green Valley. But if you look at all of the case studies, one of the things that we looked at was Brayburn Capital, which is the investment advisor to Apple, the computer company. One of the largest companies in the world has decided to have their asset management arm in Reno, Nevada. And we just looked into this further and further and further and found that there was a lot of advantages to it. In fact, you know, Apple arguably is one of the largest hedge funds in the world, and their back office is literally in Nevada.
Hmm. So, how long has that transition been taking from moving the assets out of California to Nevada? And if it's not finished yet, how much longer do you think it will take to get everything totally out of California?
Well, you can be aggressive or conservative about it,
Mm-hmm.
and we just want to do it the right way. California's been a great state for many things,
Mm-hmm.
but on a go forward basis, we're going to make a conscious effort to start companies
Mm-hmm.
and to make investments from Nevada. And to, I think, fully wind down and get out of California, it could take anywhere between 7 and 10 years to do it appropriately.
Hmm.
Not everybody does it that way.
Gotcha. Well, I wanna change. I got a couple other questions because, you know, I one of the things that I will say, and I've mentioned this to other people, is I've got a tremendous amount of respect for your experience and your brain power on the real estate side. And one of the things that you're in the process of completing, which I think is a really important topic, which I'm excited to read at some point in time, is this book you've been working on, right? So tell me a little bit about this book, because I know that, you know, as we move forward, it's things like this that I want to expose to families, because you know, the whole objective of this whole FOR thing, family office real estate, is to provide education so that, you know, families can learn to continue growing their assets or building generational wealth. And the aspects of this book is really sort of marrying a Warren Buffett philosophy, but on the real estate side, correct?
It's very correct. So it just so happens that I'm in alternative investments
Mm-hmm.
and real estate investing. But my real love and passion is public equities. And the 10K and the process of analyzing a company with a lot more information
Mm-hmm.
is a better way to invest, generally speaking, in a more efficient marketplace.
Mm-hmm.
Real estate, however, is the exact opposite. In fact, it's not insider training, it's not insider trading to go find out information that you might not otherwise learn or achieve. So in real estate, it's how good are you at being a detective?
Mm-hmm.
How good can you underwrite and collect all of these information and data? The problem is real estate is by far one of the most multidisciplinary and complex asset classes in the world. There's jurisdictional issues, there's currency issues, there's regulatory issues, there's tax issues, not to mention operational execution.
Mm-hmm.
And it's not just by MSA, it's actually by neighborhood.
Mm-hmm.
So when you, the construct of all of this is, how would Warren Buffett invest in real estate if he so chose? And we have several case studies of him doing so. It should be very business-like, whether you're investing in a farm or a distressed asset in Manhattan that he has, you know, used as examples in the past. But I take it a step further and making it basically the intelligent real estate investor. Really, everything that Warren Buffett tries to do is invest in things that are equity bond-like. And what I mean by that is, if you were to invest in a bond at the end of 10 years, you're going to have nothing as far as residual value goes, other than you're going to have 10 equal payments and you would have made your interest on that bond allocation. And on an after-tax basis, that's ordinary income. But when he invests in public equities, he does the exact opposite. He's investing in an equity position with a margin of safety, and he is getting an annual coupon, and hopefully over the duration of time, that monthly or yearly dividend, that coupon, is increasing each year, as well as the company valuation. Now, how do you apply that to real estate? And that's really what the essence is of this book is, do you want to have the same after-tax net of fees benefit that you can get in the public equity markets? Can you get that in real estate? And my argument would be that real estate can actually be a more favorable asset class. So how would Warren Buffett, in theory, invest in real estate? Well, you want to invest in an asset that's not going to lose value.
Mm-hmm.
You're going to want to have a dividend or coupon or NOI increase over time. And you're going to want to have after-tax benefits, which
Right.
depreciation provides. And what's really unique about this, DJ, is if you look at Warren Buffett's annual shareholder letter,
Right.
he always measures his returns on an after-tax, after-fee basis, whereas the index that he's comparing his investments to is the S&P 500,
Yeah.
which is before tax,
Yep.
but it's inclusive of all of his reinvested, the S&P 500 reinvested earnings. So it's not even apples to apples, and yet he's still beating the S&P 500. So if he is investing and marking his return or measuring his return on an after-tax basis, then my argument would be then we should be too in the real estate industry. And the culmination of the 15 chapters is going to be the concept of the equity bond and how to apply that to real estate.
That's fascinating. And by the way, I know you've mentioned some of this, whether your book title is Value Add in Investing or whatever the case is, value investing in real
Applied
estate.
value investing.
But you said something that could be a great book, and you said the intelligent investor, something about the intelligent investor in real estate.
Yeah.
Something like that, which is actually pretty cool. So,
well, there's an author that I need to give credit to on that, and that is, I believe, Brad Thomas,
mm-hmm.
and he writes for Forbes, and he's a good friend of mine, and he has written a couple of things on REITs, but I'm not the first to come up with this concept. The difference is, I'm not aware of any practitioner that has written on these concepts,
Yeah.
and that's where I want to bring in the experience of applied practice.
Yep.
And I want to go through both the public equities,
Yep.
So that would be equity and mortgage REITs.
Yep.
I want to go through the different categories of real estate, such as core, core plus, value add, and opportunistic.
Yep.
And getting down to the co-investment GP structure, and going through the different capital stacks.
Yes.
So at the end of the day, not only is it an after-tax return analysis, but how close do you want to get to the asset?
Yeah.
Are you merely a lender? Are you merely a shareholder in a REIT?
Yeah.
Or do you want to be in the operational aspects of the real estate? And by the way, the closer you are to the asset, not only is it better governance,
Yeah.
but in my opinion, you have better control and tax breaks.
Yeah. That's interesting. I know you've been working on this for quite some time, and like I said, I'm very excited to read it, and it looks like you're going to be able to put it on a great platform, for publication and everything else. So I'm going to ask you one last question, which is over, and where do you feel we are currently as of the end of 2018 in real estate? Do you feel that we're on the edge of something happening from a downturn perspective? Do you personally think it'll continue to go? I mean, I've got my opinions, which I share often, but I'd like to hear what you think.
Yeah, so let me just share a couple of examples and use that applied
Perfect.
Value investing perspective. So when you're acquiring something, you want to have a margin of safety.
Mm-hmm.
So a margin of safety to me would be that you're buying it below wholesale, which is below replacement cost, which is basically looking at a cap rate or a multiple perspective. You want to be buying well below where others are buying and
Right.
entering the market.
Yep.
So to do that, I think in today's market, that requires some construction risk.
Yes.
Even though there are tariffs and labor shortages, I think you can still, all things being equal, I still think you can get into an asset through construction and taking that development profit versus buying an asset that's stabilized at a 4 or 5% cap rate, especially at today's rates. At some point, your cap rate is not going to be accretive to the debt levels.
Correct.
And at some point, they're not going to service.
Yep.
So from that perspective, I'd say be wary. I also was listening to Howard Marks's book on the way down to this conference, and he has 25 chapters on cycles. It's a phenomenal read. I highly recommend your audience to read it. But again, it's relative, and many of these large institutions have what's called an institutional imperative. meaning they have to deploy money.
Yeah.
And they need to deploy money to earn fees and carried interest. And on a relative basis, they are going to compare other investments at the current time in the market. So even if there is a market correction, they're being paid to take that risk. And in fact, if they don't allocate capital, they're penalized for not executing on the strategy. So in my opinion, it depends on location, it depends on property type, it depends on neighborhood, it depends on what kind of capital you have access to. For example, deals that we were underwriting in your neck of the woods just earlier this year.
In Denver. Yep.
At the beginning of the year, penciled phenomenally.
Mm-hmm.
And by the end of the year, before construction was to begin, construction had increased by 30%, both for material and labor shortages were an issue. And our bare minimum investment hurdle is 15%.
Yeah.
And you can measure that in a few different ways. Return on cost, you can look at an IRR look back, levered, unlevered after tax. But at the end of the day, it wasn't even getting close to that. So we have to either not move forward or pivot to a different property type.
Right.
So where do I think we are at in the market? I certainly think that we're in extra innings. However, if you look at Dr. Mueller's work, he argues that real estate is not necessarily the typical 5 to 6 year business cycle, that real estate is a longer cycle of 20 years.
Right.
And if you look at what Brad Case has done at NAREIT, he would argue that we still have 5 to 7 years left of growth in this real estate market. So that's by valuation basis, that's by cap rate basis, and that's according to the NAREIT data that they collect. So I think it's just not willy-nilly. You can't just show up as a marketplace lender and lend 90% of purchase price and escrow your rehab money. And some of these people are putting in equity from crowdfunders. So what is their real skin in the game? Nothing.
Yeah.
You can't just come in and act like you can construct because, there's a lot of supply coming online.
Yeah.
So this is a market. This is a free market. This is capitalism at its best. And I think that those who are seeing a lot of deal flow are going to have a comparative analysis to take a look at what's a great investment. So you have to always be in the market. You can't just pull yourself off the market and go into cash. That's a negative carry. But you can be selective and programmatic, and if you invest with a margin of safety and as an applied value investor, I think you're not going to lose money.
It's you said Glenn and Glenn Mueller. I consider him the grandfather of market cycles, just because Hoyt was the first one back in '33 that did it through Chicago, and then Glenn's taken that to a whole nother level, and he's actually going to be in our upcoming issue in January. He's got a couple charts and graphs and also just a great narrative on the whole thing. And the last 2 issues, we had a friend, Akil Patel, out of the UK. Glenn read his stuff, and Glenn was like, "No, this was written really, really well." And Akil's philosophy is, look, you can go back 250 years. You can look at it dates back, over 200 years, where you have data, not only from the U.S. but the UK and Australia, that cycles run in 18-year cycles. I know you said Glenn said 20. And so based upon that, he's like, okay, we are going to see a dip, probably be 6 to 9 months probably. And then, similar to what the gentleman you said at NAREIT, is that we're going to see actually a greater acceleration than what we saw the last 7 years. And then we'll hit another recession around 2026, 2027. So there's definitely that continual opportunity. But, in Denver, we were talking about Denver, there's 2 years of excess supply, right? And a lot of the people that are just putting money out there because that's the business, which fortunately family offices can be patient, you can run into, some problems. So, all right, one more question then. And I know that last time I was in Nevada, you took me to the old part of Las Vegas, where the founder of Zappos has been gentrifying that area really over the period of time. That lands within an opportunity zone.
Yes, it is.
So all you hear at these events are opportunity zones, opportunity zones. I had a conversation with a gentleman last night that has spent a lot of time up on Capitol Hill talking about this stuff, and he goes, "Well, why do you think that there's going to be issues?" And as we continued to speak, now it brought more concerns to me at the time, and I know you don't know what we spoke about, but as a whole, on the surface level, because we're still waiting for some of the information to come out, what are your thoughts on these opportunity zones? Do you really think that there is a great opportunity? Do you think somewhat? Do you think not at all? And what's your position, family stance? Are you in a wait and hold mode, or what's the case?
Well, that's very interesting. You and I were at Stanford 2 weeks ago,
Yeah.
and they had a very interesting panel on this with some capital market professionals from New York. And I would probably echo and resonate some of that commentary in that not every investment is going to be a favorable one inside of the opportunity zone. And you shouldn't just do an investment for tax purposes. I received a phone call yesterday before coming down here from one of my closest friends who's not in the real estate industry, who just came across some capital gains, who was asking me if I was aware of any investment opportunities. I said, look, stand by. We don't even know all of the details yet of this opportunity zone regulation.
Correct.
But I would say that, again, by neighborhood, there may be some fantastic opportunities. But like in so many things, you can be the first one in and have problems.
Yeah.
And I don't want to be the first one in just to get a tax break.
Right.
But there are opportunity zones. For example, after this conference, I'm going to be going to San Diego. And on University Avenue, there is a group who is trying to do VA housing through modular. And they got a 55-year allocation for some tax credits and vouchers. And that, on a leveraged basis, and not including after tax, is going to be about a 33% IRR look back over a 5-year period.
Wow.
But now you're looking at California's tax system again.
Right.
Now you're getting you get real property deduction, but not personal property deduction.
Mm-hmm.
And so your depreciation bonus schedule is what they're really selling inside of an opportunity zone. Well, in that scenario, it underwrites fine on the merits of the deal. The after-tax depreciation bonus schedule is going to be phenomenal. So you got to add that back to your bottom line. So it's going to be a better than 33% IRR look back. And oh, by the way, it's in an opportunity zone. So if and when you ever decide to sell, you may have some advantages. But more importantly, maybe that next person in who wants to take advantage of that tax structure of an opportunity zone, that will be just another incentive for him to do so.
Yeah, I see, and I see that, and I continue to say this, you still have to go to the fundamentals of the deal. Is this a good deal, right, to invest into? A gentleman here yesterday was saying, oh, they're the best thing ever. It's supposed to be from a family office, and he's like, I can put money in, I don't have to pay taxes on it. I just have to, wait it out for 10 years, sort of land bank. And I'm thinking to myself, okay, well, based upon that, if you got no return, you got like 2% on your money. Is that really a good investment when you could have rolled that over multiple times? So I do think you need to dive in more, to that whole thing. And I'm with you too, to sort of a wait and see, what ends up coming out in the end, because there are some changes that still need to be made. And I think that, like you said, it's the cherry on top, really. I just wrote an article I submitted, actually, and I got up late at night. This was for Forbes, and I literally said, and I went and watched a movie last week, Wag the Dog, which was,
it's a great one.
Yeah, right, 20 years. And the reason I did that, because I think in a lot of ways people are the tails, or the dog's wagging the tail, or the tail's wagging the dog instead of the dog wagging the tail. And so they're leading with that tax stuff. So, well, Randy, I want to thank you very much for, I always appreciate when we have a chance to chat and everything. And this won't be the last time we'll want you on here because of your expertise and experience and whatnot. But, excited to see what the article is going to be like coming out in a couple months. And, excited to learn more about the family and everything else. So
I'm excited to see what's happening in this family office space, and you've been a champion for years at what you're doing, and I think this is going to be a tremendous benefit to families, with whether or not they have expertise in real estate or not.
Right.
This is very specific material that can benefit them, and I'm excited to see the future success of this magazine.
Well, we're gonna with the launch of this 4 News, we're also gonna be having some invite-only events, and it's strictly, one of the policies that we have is if you're trying to raise money, you cannot advertise, and so it's really going to be content-driven. In fact, Glenn, you mentioned,
Yes.
is going to be speaking at an upcoming event, and
Don't want to miss him.
no, and a lot of other very great people. So this is DJ Van Kuren, from the Heyman family office, but for 4 News, Randy Norton with Green Mesa Capital. Randy, thank you so much.
Thank you for having me.
And look for more information on the next edition. Thanks,
Really
man.
cool.